Hi everybody, welcome to another episode of Q&A with Oriana Shea, and today we are going to talk about those rascally rates. So today we're going to be talking about the interest rates and everything that's going on, and I have a very special guest, Josh Atwood from Finance America, because I am not a loan expert by any stretch. So I'm going to ask Josh a few questions and get a professional's insight on what is happening with these crazy interest rates. Josh, welcome.
Thank you.
Thanks for joining me. How are the rates today compared to, let's say, 2018, 2019?
Yeah, great question. I mean, we are still seeing historically low rates. Rates right now are in the low 3%. And if we take a look back in 2018, we were about 4.5%. So we've seen rates really come down over the last couple of years.
I mean, it's staggering. And to put it into real numbers, if you were financing a $500,000 mortgage, let's say back in 2018 versus today, what were the payments back then versus how, like, what does that really look like?
Right. I mean, I think that's a great question because a lot of times when people are buying a house, the overall number is important, but also too, what am I paying monthly? That's really what people are looking at. So if you look back in 2018, if the rates, let's say we just go off 4.5, mid fours, right? Your payment just for the principal and interest is going to be about $2,500. When we look at today's rates, let's just say 3%, you're looking at about $2,100. So it's a $400 a month difference.
I mean, that's
in monthly
huge.
payment.
That's huge.
It is.
$4,800 a year in savings. That's amazing. So the burning question we all want to know, how long are the rates going to remain where they are? We know that nobody has a crystal ball, but we know that in the finance world you guys have some insight. So what are you seeing? What are you anticipating is going to be coming down the pipe?
Yeah, I mean, I think that's another great question when it comes to rates, and
I like to ask good questions.
and one that we always struggle with, right? Because there's so many unknowns when it comes to what's going on, and I think the 2020 with COVID just has been upended a lot of things when it comes to interest rates and in terms of what is predictable, right? So the 10-year Treasury historically is what sets 30-year fixed rates. So that's going to be one of the benchmarks that we look at. And with everything going on, with the government pumping so much money into the economy and that stuff, it's kind of taken some of the gas out of the 10-year Treasury. And so we're kind of floating in the wind a little bit with rates. But as we look ahead, the economists are starting to beat the inflation drum. And so that is something that is concerning us because with inflation going up, what's right to follow are interest rates going up. So right now, there's more upward pressure on rates than we've seen in a long time.
Do we think it might be coming towards the end of the year? I know you don't have a crystal ball.
I mean,
when's it happening?
We don't know, and I think, and it's
because we're hearing that everything is going to continue, pretty much stay stable in terms of the rates through the rest of this year, but maybe towards the end of the year, things might start to...
I think that's probably realistic. I think that we are hopefully in an environment where that will continue. And as the year goes on, that pressure increases for the possibility of rates going up. So I definitely think that we can see that happening as we get further into the year. And hey, we're almost... we're trudging right along through 2021.
I mean, that's a whole nother topic, whole nother conversation. If you were going to give a buyer some advice right now who's on the fence and not sure whether it's the right time to buy or whether they should wait, what would you advise them? If this was, let's just say, your brother or your sister, right, and they're on the fence, what would you tell them?
Buy now. I mean,
hurry.
Here's the thing with interest rates. If let's say that there's a huge drop that comes 6 months from now, great, you refinance your property. But until you have a property, you have nothing to leverage. So in terms of trying to time the market, if you can afford the payment and you have some money saved, then the best time to get in the market is now. And then if rates go down, great. then you refinance and get a lower payment. If they go up, you've locked in today and you're good to go.
Yeah. And the concern that I hear, or remember what happened in 2006, 7, and 8, and I keep trying to explain to buyers that this is not that. This is not the same situation as that market.
Yeah,
so,
and I think there's two really good points on that. One is we're not in the same environment that we were in 5, 6, 7 that led up to 2008. Right. So we're just not in the same lending environment. When I started in the business, it was that time, and the way that you qualified someone was you said, well, what do you want your payment to be? That was the question. Now we say, well, how much money do you make, right? And so the way that loans are done are still being done in a traditional sense. So I think that's one of the important factors, is the risk for people defaulting on their mortgage is very low. I think another component of that too is I kind of feel like if something was gonna break the housing market, don't you think a global pandemic might have been it?
You would think.
And so we're now a year and a half basically past that. And housing this time was a part of the solution.
Yeah.
It wasn't driving the problem. And in 2008, housing was driving the problem. Yeah. And so now housing is part of the solution. You can refinance and save $400 or $500 a month. There are options that are out there. So I think you're right in that the way loans are done are not setting us up for a huge amount of default going on in the future that's going to lead to a huge a huge wave of foreclosure short sales. The other component,
that's the key.
The other component that I think is really important, the people who sold in 2008 and 9 and 10, maybe they didn't have a choice, but those who stayed with it and continued to make their payment, continued to do that, are they better off now than they were in 2006?
Oh my God, yeah.
Absolutely. Yeah. So it's not to say that if you sold during that time, oh my gosh, whatever. I mean, people were losing jobs. It was a huge recession. But if you had the staying power and you waited it out, you're still ahead of the game. So I would argue the next time we see this happen, if you can ride it out, you're going to be ahead of the game. You're going to be ahead.
It's crazy to think about what that might even look like. But that's history. That's the data. I mean, that's what the numbers show us. Josh, thank you so much for joining me today, and thank you guys for joining us for another episode of Q&A. And as always, please like, comment, or subscribe, and we'll see you next time.